My name is Garth McKenzie. I'm a technical analyst and an ETF strategist with traderscorner.co.za. In this episode, I'm taking a look at the S&P 500, and we'll begin with a weekly chart looking at the really big picture, and then we'll zoom it in and start to look at the daily charts and the hourly charts with a more recent and more actionable trading view of the market as it stands at the moment. My first chart this week is a long-term chart. It's a weekly chart of the S&P 500, and it is a line chart. In other words, the week-to-week trading activity is joined together with a line. There's no candlesticks or any other fancy stuff on this chart. And the reason I've put it up as a line chart is simply because it shows you the end of week closes. And what's quite evident here is the rising trend that goes all the way back to the 2009 low when this most recent bull market began. And you can see how the S&P 500 has trended beautifully higher over the last 10 years. And each time the market has pulled back to that long-term upward trend, it has found buyers and has managed to push up off that support and continue to the upside. But that all changed now in February and March of this year, obviously with the coronavirus pandemic and the subsequent market crash that we saw occurring after that. And you can see now that the market has broken down below that long-term rising trend. It gave a significant breakdown. And what we now have, however, is a very powerful rally over the last couple of weeks, which has given a throwback to the underside of that previous rising trend. Now that means the market's at quite a critical point now, because that previous support line now becomes resistance. And if the market fails at that resistance area, then it may indicate that there's another leg lower to come. And that leads me on to the next chart, which is also a weekly chart of the S&P 500, but it's just a shorter term view looking at the last year or so. And what's evident here is that you can see the big bounce off of the 2200 level that occurred in late March. The market's traded all the way up to about 2900 recently. So a very powerful, more than 30% rally on the S&P 500 off those recent lows. But notice how the market traded up into that zone between the 50% and the 61.8% Fibonacci retracements. And what we saw last week was a big weekly reversal candle, and that took the form of a shooting star candle. And that occurred right off of that 61.8% Fibonacci retracement level. So that in itself is quite significant. And it suggests that the market is acknowledging that resistance zone around the 61.8% retracement. And from here, it's quite feasible that we could see some consolidation, perhaps a bit of sideways trade, or maybe even a little bit of a pullback of this most recent rally off the lows. My next chart is then a daily chart of the S&P 500. And what's evident here is the rising wedge pattern that has formed off of the lows since late March. A rising wedge is typically a continuation pattern within a generalized downtrend. And what's notable here is that the market does begin it does look as if it's begun to break down below the bottom end of that rising wedge pattern, following that weekly reversal that I spoke about in the previous slide. Also evident here on the daily chart is the negative divergence that you can see on the stochastic oscillator. And that is an indication that the upward momentum has been losing steam over the last couple of days, and it does very often preempt a bit of a pullback. Now, my final slide today is zooming in even more closely on the action in the S&P 500, and it's an hourly chart. And what we've got here is really the hourly trade over the last month or 5 weeks, really. First thing to point out is the island reversal that we saw on the market last week, Friday. And you can see how the market gave back quite a bit of the gains on the day there. And an island reversal happens where you've got a body of trade like that, it's got a gap on either side, and effectively that's like a little island that's broken away from the rest of the trading activity. The fact that the S&P 500 is trading below its 15-period exponential moving average on the hourly chart is also a little bit concerning for me, and that gives me an indication that the market is slightly weak at the moment. Big support levels to watch at the lower levels are 2800, which was tested in yesterday's session, and the market bounced off that level. Below that, 2725 would be your next lateral support, and if that goes, then your next support would come in all the way down at 2630. Below that, there's a gap down at 2,500, but that's quite a long way away, so I don't think we're going to look at that just yet. But for the moment, I think keep an eye on those support levels that I've mentioned as indicated there on the chart. That's all I've got for you on this episode. I'll be back again later in the week with a look at the Russell 2000.